Hello, my name is Fangxu. Today I'm gonna talk about a very famous investment book. The book name is The Intelligent Investor. It was written by Benjamin Graham. He was an American economist and investor. This book's objective was provide an investor policy book for the ordinary investor. He succeeded in putting seemingly hard concepts into terms that could understand and, more importantly, implemented by the average investor. The intelligent investor puts special emphasis on teaching risk management through asset allocation and diversification. Secondly, maximizing probabilities through valuations, analysis, and margin of safety. Thirdly, a disciplined approach that will prevent consequential errors to a portfolio. This book can be divided into several parts. The first part is about investment, speculation, inflation, and market history. In terms of investment and speculation, in my opinion, intelligent investing includes analysis of fundamental soundness of a business and a calculated plan to prevent a severe loss and the pursuit of reasonable return. However, speculation involves basing decisions on the market pricing and hoping that someone will pay more than you at a later date. Unintelligent speculation would include speculating when you believe you are investing. As Chapter 2 discusses the inflation in more depth, Graham shows how inflation has occurred in the past and concludes that intelligent investors must allow for the probability of continued inflation in the future. Given that we must allow for the inflation in the future, that will have an impact on the investment that may make. The second part is about the defensive investor. Who is the defensive investor? The defensive investor is unwilling or unable to put in the time and effort required to be an enterprising investor. The two main advantages of stocks are that they provide protection against inflation and offer a higher rate of return than bonds or cash in the long run. These advantages can be squandered if the investor pays too high a price for his stock. Graham suggested four rules for the defensive investor. The firstly is adequate diversification, and secondly is stick to a large, outstanding, conservative companies. The thirdly is about each company should have 20 years of continuous dividend payment. Last thing is limit the price you are willing to pay to. The third part is about the enterprising investor. Who is the enterprising investor? The enterprising investor has the time and experience in investing to expand the possible universe of opportunities beyond conservative investment. The enterprising investor can begin his search by looking for the companies that meet the following criteria. Unlike the defensive investor, the enterprise investor has no minimal limit on the size of company. The criteria is like strong financial condition, earnings stability, current pays a dividend, current earnings greater than years ago, stock price less than 120% of net tangible asset. The first part is about missed market and fluctuations. Many investors focus on timing the market. In other words, they try to predict market through direction of various other indicators they believe predict the future. Mr. Graham contends it is absurd to think that the general public can ever make money out of market forecasts. Throughout The Intelligent Investor, Graham demonstrates that the investor should use pricing to make buy and sell decisions. We want to buy stocks when they are priced below their fair value and sell stocks when they advance above fair value. Mr. Market is an emotional man who let his enthusiasm and despair affect the price he is willing to buy or sell shares on any given day. The fortunate aspect of this parable is that the Mr. Market does not care if you take advantage of him. He shows up every day with a price he is willing to buy or sell shares. This part is about investment funds and advisors. The defensive investor may choose to invest in investment funds. These investment vehicles provide a convenient means for saving and investment, and possibly prevent individuals from making costly blunders. However, the investor should expect no more than average result. It is important that cognizant of high fees, excessive trading, and erratic fluctuations in performance. Check the performance for at least the last 5 years. Investors should look for advisors with the utmost highest character who are conservative, guarded, and proficient in the investment field. Mr. Graham said that much bad advice is given free. How true is that? This part is about investment selection. In investment selection, it is most accurate to be able to make judgment based on past performance. The greater the amount of assumptions that have to be made about the future, the greater the possibility of misjudgment or error. Graham used Chapter 13 to provide historical examples of investment selection in action. He details fundamental ratios that shed light on performance and price. The leading factors of performance are profitability, stability, growth, financial position, dividends, and price history. On the other hand, the attitude of investor is important in common stock in investment selection. A value approach will be more skeptical of high multiple valuations based on expected high future growth or short-term earnings. Many times, the lower multiple valuation with the slower stable growth will be the long-term winner. In my opinion, I also think attitude is a key factor while people investing. This reminds me a story. It is about 3 blue-collar workers, different life. Someone asked these 3 guys same question, "What are you doing?" The first one replied with a little bit angry, "I am working and lifting building. Don't you see it? It is a not easy job." The second one said with a little bit smile, "I am building a tall skyscraper." The third one answered with a big smile, "We are construct a new building. This tall building will be one of the city's signal." 10 years later, the first one is still a blue-collar worker, and the second one is an engineer working in the office. However, the last one is the boss of the construct company. The same people have absolutely different attitude. This changed their entire life. So I think attitude it is very important. The last part is about margin of safety. At the chapter 20, Benjamin Graham called margin of safety the secret of sound investment and the central concept of investment. The margin of safety for an investment is the difference between the real value and the price you pay. The goal of value investor is pay less than the real value. Almost anyone with a little knowledge and hard work can analyze the past, Mr. Graham demonstrates the importance of this exercise throughout The Intelligent Investor. However, even the best analysts are unable to consistently and accurately forecast the future. The function of having a margin of safety is to make accurate forecasts of the future unnecessary. In other words, having the margin of safety allows for inaccurate forecasts. It's giving you leeway for conditions that are less than optimal because this is usually what happens.